You know how in our last video we talked about interest rates and how beginners overthink trying to predict them? Well, there's a strategy that removes the guessing game entirely. It's called bond laddering, and it automatically gets you better yields no matter what rates do. Think of it as investing on autopilot. Today, I'm showing you exactly how to build one, even if you've never bought a bond before. Let's keep this simple and practical.
A bond ladder is simply buying multiple bonds that mature at different times instead of putting all your money in one bond. According to Bankrate's 2025 guide, each rung of the ladder represents a bond, with the lowest step being whichever bond matures soonest. When that bond matures, you reinvest the money in a new bond at the long end, extending your ladder upward. The beauty? You're never locked into one interest rate, and you always have bonds maturing regularly to give you flexibility.
Here's a simple beginner example. You have $10,000 to invest. Instead of buying one 5-year bond, you create a 5-year ladder by investing $2,000 each in bonds maturing in 1, 2, 3, 4, and 5 years. M1 Finance's April 2025 guide shows this exact structure. Year 1, your first bond matures. Reinvest that $2,000 in a new 5-year bond. Now you have bonds maturing in years 2, 3, 4, 5, and 6. You just extended your ladder. This cycle continues forever.
Why is this powerful? Benefit number 1. It manages interest rate risk automatically. Charles Schwab's Bond Laddering Guide explains, when rates rise, you reinvest maturing bonds at higher yields. When rates fall, you still have longer-term bonds locked in at higher rates. State Street's 2025 analysis confirms you avoid getting locked into a single interest rate for years. This is exactly what we talked about in the interest rates video, except now you don't have to guess which direction rates are going.
Benefit number 2, predictable income stream. Fidelity's October 2025 ladder guide notes that as each bond matures, it provides a known amount of income. You can even structure monthly income by having bonds that mature in different months. Bankrate confirms this is particularly helpful for retirees with predictable expenses. But even if you're not retired, having regular cash flow gives you options: reinvest, use for expenses, or adjust strategy based on your changing needs.
Benefit number 3, opportunity for higher returns. As BlackRock's 2025 analysis points out, bond yields along the curve remain elevated, with some offering better income opportunities in 15 years. When your bonds mature, you can reinvest in new bonds that may offer higher yields if rates have risen. State Street confirms this helps defend against inflation too. You're not predicting rates, you're positioning yourself to capture whatever rates are available regularly.
Now you're thinking, why not just buy a bond fund like BND? Fair question. Bond funds are simpler. One purchase, instant diversification, done. But PIMCO's October 2025 analysis explains ladders give you control over maturity dates and cash flows. With a fund, the manager decides when to buy and sell. With a ladder, you control when bonds mature and how to reinvest. Plus, Fidelity notes bond ladders help manage interest rate risk in ways funds can't. You hold to maturity, avoiding price fluctuations.
When do ladders really shine? In rising rate environments. This might surprise you. Bond prices fall when rates rise, right? But PIMCO explains that ladders are actually advantageous when rates rise because maturing proceeds can be reinvested at higher rates. According to Fidelity's research, elevated yields on high-quality bonds in 2025 create opportunities to build reliable income strategies. Right now is actually a great time to start a ladder. You're locking in decent yields with flexibility to capture even better ones.
All right, let's build your bond ladder. Step 1, determine your time frame. Bankrate's guide says to identify when you first need income and how far out you want the ladder to extend. Planning for retirement in 10 years? Build a 10-year ladder. Need income sooner? A 5-year ladder works. Most beginners start with 5 to 7 years according to multiple sources. This is your timeline. There's no wrong answer, just what fits your goals.
Step 2, choose your bond types. Farther's Guide recommends focusing on quality. Look for bonds rated A or better. You've got 3 main options. U.S. Treasuries are safest, backed by the government. Corporate bonds from strong companies offer higher yields but more risk. Municipal bonds provide tax-free income if you're in high tax brackets. For beginners, Fidelity suggests starting with Treasuries or high-grade corporates. Keep it simple and safe while you learn.
Step 3. Buy your bond rungs. Most brokers like Fidelity, Schwab, and Vanguard have bond ladder tools, according to Bankrate. Schwab even has a CD and Treasury ladder builder that makes it simple. Buy one bond for each year in your time frame. If you're building a 5-year ladder, buy 5 bonds, one maturing each year. State Street notes individual bonds typically have a $1,000 minimum, so a 5-rung ladder needs about $5,000 minimum to start.
Step 4, reinvest as bonds mature. This is the automatic part. When your shortest bond matures, take that money and buy a new bond at the longest maturity. Faster Capital's guide explains this keeps your ladder going indefinitely. The key is consistency. Don't get tempted to spend the maturity proceeds unless that was your plan. This discipline is what makes ladders work. BlackRock notes that staying invested through the cycle is how you capture the strategy's full benefit.
Here's a beginner shortcut. BlackRock's iBonds ETFs. These are ETFs that mature like bonds. They're basically pre-built ladder rungs. Instead of researching individual bonds, you buy iBonds with different maturity years. BlackRock's 2025 analysis notes iBonds make laddering simpler and more time-efficient versus individual bonds. They're available in treasuries, munis, and corporates. For beginners intimidated by individual bonds, this is a fantastic middle ground between bond funds and traditional ladders.
Let's talk realistic expectations. Bond ladders aren't get-rich-quick schemes. They're get-steady-income strategies. With current Treasury yields around 4 to 4.5%, according to Fidelity's 2026 outlook, that's what you can expect. Not exciting, but way better than the near-zero yields from a few years ago. Charles Schwab emphasizes ladders help smooth out interest rate volatility. That's the real benefit. You're trading explosive gains for reliable, predictable, stress-free income.
Common mistakes to avoid. Mistake 1. Buying callable bonds. Issuers can pay these off early, ruining your ladder. Municipal bond guides warn to focus on call protection. Mistake 2. Chasing yield with low-quality bonds. Farther's Guide says stick with BBB or higher ratings. Mistake 3. Building too short a ladder. You need at least 5 years to get the benefits. And mistake 4. Forgetting to reinvest when bonds mature. Set calendar reminders.
Who should use bond ladders? 3 perfect candidates. 1. Retirees or near retirees who need predictable income. PIMCO notes ladders create steady cash flow for living expenses. 2. Conservative investors uncomfortable with stock volatility. Fidelity confirms bonds reduce exposure to volatile stocks. 3. Anyone with specific future expenses, college tuition, house down payment, etc. But if you're young with decades until retirement, you might be better off in stock index funds for growth.
How do ladders fit your overall portfolio? Think of them as your bond allocation. If you're following a 70% stocks, 30% bond split, that 30% can be a bond ladder instead of a bond fund. This gives you the stability of bonds with more control over cash flows. State Street's research shows bond ladders integrate well with other investments by balancing risk and return. Don't make ladders your entire portfolio. Use them strategically for your fixed income allocation.
Bottom line, bond laddering removes the interest rate guessing game by spreading your bonds across multiple maturity dates. You get predictable income, flexibility to capture rising rates, and protection if rates fall. Start with a simple 5-year Treasury ladder using your broker's tools, or use iBonds ETFs for simplicity. Current yields around 4.5% make this a great time to begin. If this video helped, hit like, subscribe for more calm, practical investing strategies. Comment, are you building a ladder or sticking with bond funds? Either works, just understand why you chose it. Now let's keep building that wealth together.